My dear friends, welcome back. Today we must discuss a subject that every generation of investors tries to ignore until it is too late. Recession. Now, let me reassure you, recessions are not monsters hiding in the dark. They are natural, recurring phases of the economic cycle. But while recessions themselves are predictable, the behavior of investors during recessions is not. And that, my friends, is where fortunes are lost and where fortunes are made. I lived through more recessions than most investors will ever study. I watched how markets collapsed in 1929, how fear consumed Wall Street in the 1930s, how optimism inflated too quickly in the 1950s, and how reality returned again and again. Over time, I recognized a simple truth. People do not suffer because recessions arrive. They suffer because they enter them unprepared. You see, recessions do not destroy sound investors. They destroy fragile investors, those who relied on luck, momentum, or stories rather than discipline. Those who built portfolios with no margin of safety. Those whose emotions were tied to rising prices rather than enduring value. And so, in this lesson, I want to give you something practical. The blueprint I taught my students more than 70 years ago on how to prepare for recession long before it arrives. A blueprint that protected them through panic, uncertainty, and the unpredictable storms of the economic cycle. And my dear friends, this blueprint will protect you as well in 2025, 2030, and every decade that follows. But first, let us understand why recessions feel so painful to the average investor. It is not because businesses suddenly vanish. It is not because the economy suddenly collapses. It is not because value disappears. It is because confidence evaporates. People build their identity around rising markets. They assume the upward slope of good times will continue indefinitely. They confuse price with strength. They confuse optimism with safety. And when the slope turns downward, even slightly, their emotional foundation cracks. Fear grows. Uncertainty spreads. Impulse replaces judgment. Suddenly, investors who were fearless during bull markets become paralyzed during recessions, not because their businesses have changed, but because their psychology has changed. This is why preparation is more important than prediction. Let me repeat that. Preparation is more important than prediction. You do not need to know the exact month a recession will begin. You do not need to forecast interest rates, inflation, or unemployment. Those who try usually fail. But you can build a portfolio and a mindset strong enough to withstand any recession. Just as a well-engineered bridge withstands storms without knowing the exact moment the wind will rise. And this is what intelligent investors do. They prepare while others celebrate. They strengthen their financial position while others chase excitement. They build discipline while others build expectations. They focus on value, durability, and resilience, not momentum, noise, or predictions. My blueprint for recession preparedness is built on 3 pillars. Financial strength. The companies you own must survive, not merely thrive. Psychological liquidity. Your mind must remain calm when prices fall. Margin of safety. The gap between value and price must protect you from uncertainty. If you master these pillars, recessions will no longer frighten you. In fact, they will become your greatest opportunities. Now, my dear friends, let us begin with the first pillar, the foundation upon which every resilient portfolio is built: financial strength. How intelligent investors prepare for recession, my blueprint. Let us now turn to the first pillar of recession preparedness, a pillar so fundamental, so non-negotiable, that without it, no strategy, no optimism, and no amount of analysis will save an investor. That pillar is financial strength. In good times, weak companies look strong. In rising markets, fragile balance sheets appear healthy. In euphoric environments, even unprofitable businesses can pretend to be valuable. A bull market forgives everything, but a recession forgives nothing. This is why intelligent investors anchor their decisions not on excitement, but on strength. Strength that can be measured, strength that can be verified, strength that does not disappear when confidence collapses. And financial strength always begins with a single question. Can this business survive a period of difficulty? Not can it grow? Not can it beat expectations? Not can it dominate the headlines? Survive. That is the first requirement. Let me explain what financial strength truly means. 1. The balance sheet is your first line of defense. When storms arrive, whether in 1932 or 2025, the only companies that endure are those with ample liquidity, manageable debt, reliable cash flows, and a conservative capital structure. A company with strong current assets and low short-term obligations has the flexibility to withstand declining sales, tightening credit, and falling investor confidence. But a company that depends on constant borrowing, constant enthusiasm, and constant growth becomes vulnerable the moment the wind changes direction. In recessions, debt becomes heavier, cash becomes precious, and the companies with poor balance sheets become trapped. Intelligent investors do not wait for a recession to arrive before assessing this. They analyze balance sheets during calm periods when clarity is available and prices are reasonable. Because when fear finally appears, it will be too late. 2. Earnings durability matters more than earnings. Growth. Most investors focus on growth. They want businesses that expand quickly, increase market share, and deliver rapid excitement. But during recessions, growth evaporates. What matters is not how fast earnings grew during good times, but how stable earnings remain during difficult times. A business with modest but steady earning power is far safer than one with explosive but unpredictable profits. I often advised my students, do not be impressed by acceleration. Be impressed by consistency. A recession reveals whether a company's competitive advantage is real or imaginary. Can the business maintain essential demand? Can it preserve pricing power? Can it continue generating cash even as the economy slows? These are not glamorous questions, but they are the questions that protect you. 3. The defensive investor's rule: avoid fragility. Fragile companies are not always obvious. They may appear successful. They may be admired. They may grow rapidly. But fragility hides in their structure. High leverage, dependence on cheap credit, thin margins, aggressive expansion, untested business models. When the cycle turns, these weaknesses become fatal. In every recession I lived through, I watched the same tragedy unfold. Strong companies bend, weak companies break. And investors who failed to examine fragility paid the price. This is why defensive investing is not merely a strategy, it is a philosophy of survival. 4. Cash reserves are psychological reserves. Now, here is a lesson most investors ignore. Cash is not only a financial resource, cash is a psychological resource. During recessions, prices fall, panic spreads, and opportunities emerge. But investors without cash cannot act, and investors without cash lose confidence. When confidence is lost, rational thinking collapses. Cash protects your mind as much as it protects your portfolio. It allows you to remain patient. It allows you to avoid forced selling. It allows you to see falling prices as opportunity instead of danger. The intelligent investor always keeps reserves, not because he expects disaster, but because he prepares for uncertainty. Preparation is strength. Strength creates calm. Calm creates clarity, and clarity creates opportunity. My dear friends, this is the first pillar of my recession blueprint. Build financial strength before you need it. Because when recessions arrive, it is too late to repair weakness. In our next segment, we will explore the second pillar, one of the most misunderstood aspects of intelligent investing: psychological liquidity. Your ability to remain rational during falling markets may determine more of your lifetime returns than any spreadsheet or formula. Let us continue. How intelligent investors prepare for recession, my blueprint. Now, my dear friends, let us move to the second pillar of recession preparedness, a pillar far more subtle, far more powerful, and far more neglected than financial analysis. The second pillar is what I call psychological liquidity. Financial liquidity determines whether a company can survive. Psychological liquidity determines whether you can survive. A recession does not merely compress profits, it compresses the human mind. Fear rises, hope shrinks, conviction weakens, judgment becomes distorted. Even the soundest investor can make foolish decisions if his psychological reserves are depleted. This is why intelligent investors prepare their psychology as carefully as their portfolios. Let me explain what psychological liquidity truly means. 1. The ability to withstand falling prices. Without emotional collapse. Most investors claim to be long-term thinkers. But the moment prices drop 10%, their mind begins to fracture. Suddenly, every headline feels threatening. Every opinion feels urgent. Every uncertainty feels personal. They begin checking prices constantly. They begin asking friends for reassurance. They begin searching for explanations that justify panic. This behavior is not caused by the recession. It is caused by insufficient psychological liquidity. Falling prices drain their emotional reserves faster than their bank reserves. The intelligent investor, however, does not tie his identity to short-term market movements. He understands price is temporary, value is durable, volatility is normal, and fear is not a signal. It is a test. He refuses to let the market write the story of his emotions. He maintains psychological liquidity. 2. The power to delay reaction. During recessions, the worst decisions are made quickly: fast selling, fast repositioning, fast conclusions. But intelligent investors know that urgency is almost always an illusion. A recession is not a burning building. You do not need to sprint toward an exit. You need to breathe, observe, and think. Delay is a form of strength. Psychological liquidity gives you the ability to wait while others rush, to remain motionless while others thrash, to ask questions while others search for shortcuts. A strong mind reacts slowly. A fragile mind reacts instantly. 3. The capacity to hold cash without feeling left behind. This is one of the greatest psychological challenges. During good times, investors hate holding cash. They feel impatient, embarrassed, or envious of others who appear to be making faster gains. But cash is not an admission of ignorance. Cash is a declaration of discipline. It gives you flexibility, it gives you resilience, and it gives you psychological comfort. When everyone else panics, you are positioned to act rationally. When others sell out of fear, you buy out of clarity. When others feel trapped, you feel prepared. Cash is oxygen, and recessions are suffocating for those who don't have enough. 4. The strength to stay rational in a world. Losing its judgment. A recession creates a psychological contagion. Fear spreads faster than facts, rumors spread faster than reports, pessimism spreads faster than truth. Intelligent investors observe the emotional climate not as participants but as analysts. They ask, is this fear justified by fundamentals? Is this panic creating mispricing? Has value truly changed, or has emotion merely shifted? By separating emotion from economics, they preserve psychological liquidity while others drown in anxiety. This clarity becomes their competitive advantage. 5. Confidence rooted in process, not prediction. Most investors lose psychological liquidity because their confidence is built on fragile foundations. Market performance, recent wins predictions that coincidentally came true when those foundations weaken, as they always do in recessions. Their confidence collapses instantly, but confidence built on process does not collapse. The intelligent investor draws confidence from thorough valuation, conservative assumptions, margin of safety, balance sheet strength, resilience of the business. His confidence is not emotional. It is structural, because it is based on reality, not hope. My dear friends, psychological liquidity is the difference between investors who panic during recessions and investors who profit during recessions. Strength of mind is strength of position. If you can remain steady while others lose balance, the opportunities available to you will be extraordinary. Now, let us move to the final pillar, the one that transforms preparation into protection. Margin of safety. Your ultimate defense against uncertainty. Let us continue. How intelligent investors prepare for recession, my blueprint. Now, my dear friends, we arrive at the third and final pillar of recession preparedness, the pillar upon which my entire philosophy of investing was built, the margin of safety. If financial strength keeps a company alive and psychological liquidity keeps you steady, then the margin of safety keeps your portfolio protected from the unknown. And make no mistake, the unknown is always larger than the known. Recessions do not follow schedules. They do not obey predictions. They do not respect optimism. They do not care about your portfolio, your goals, or your expectations. This is why the margin of safety is not optional. It is not a tactic. It is not a trick. It is your ultimate line of defense. Let me explain why. 1. Price is what exposes you. Value is what protects you. Most investors enter recessions with portfolios built on good stories and high prices. They believe rising prices validate their decisions. They believe excitement is a sign of safety. But when the cycle turns, even slightly, prices collapse much faster than value. And if you paid too much, if you surrendered discipline during good times, if you bought without a cushion, the market will take back more than it ever gave you. The margin of safety exists for this very reason. It ensures that even when you are wrong, you do not suffer catastrophic loss. 2. The margin of safety is a psychological tool. Many investors believe the margin of safety is purely mathematical, a discount a value gap, a number on a spreadsheet. It is far more than that. It is a psychological shield. When prices fall, as they do in every recession, investors without a margin of safety feel exposed. They panic, they rush, they sell at the worst possible moment. But investors who purchased with a margin of safety feel something entirely different. They feel calm. They know value exceeds price. They know emotion is temporary. They know the business remains intact. They know they prepared for uncertainty long before uncertainty arrived. Margin of safety is not merely mathematical protection. It is emotional insulation. 3. The margin of safety turns recessions into opportunity. Let me reveal a secret known by every intelligent investor. Recessions create the best prices of your lifetime. But who can take advantage of those prices? Only those with psychological liquidity, cash reserves, and the discipline to wait when others are celebrating. The margin of safety is not just protection, it is positioning. It allows you to buy when others cannot. It allows you to remain rational when others collapse. It allows you to invest when the world is overwhelmed. During recessions, wealth does not disappear. It simply changes hands, from the emotional to the rational, from the unprepared to the prepared. 4. Prediction is a fool's game. Preparation is wisdom. Throughout my career, people constantly asked, Mr. Graham, when will the next recession come? Should we sell now? What is your forecast? My answer never changed. I do not know, and I do not need to know. Forecasting recessions is unreliable. Preparing for recessions is undefeated. You do not protect yourself by predicting storms. You protect yourself by building a stronger ship. This is the essence of intelligent investing. Buy with a margin of safety. Own financially strong businesses. Maintain psychological liquidity. Let the unpredictable become irrelevant to your long-term outcome. Final message. My dear friends, recessions are not the enemy. Unpreparedness is the enemy. The investors who suffer are those who rely on confidence instead of discipline, momentum instead of value, and prediction instead of preparation. But you now understand the blueprint. You know the power of financial strength. You know the importance of psychological liquidity. You know the necessity of a margin of safety. With these 3 pillars, you will no longer fear recessions. You will navigate them with calm, clarity, and conviction. You will see opportunity where others see danger. And you will build wealth where others lose it. Because intelligent investors do not react to recessions. They are ready for them long before they arrive. Thank you for spending this time with me. In our next lesson, we will continue strengthening the mindset and methods that create durable wealth through every cycle. Until then, stay disciplined, stay patient, and always insist on your margin of safety.